Right, let me in this chapter go through one of the techniques, systems, call it what you will, that I like. Remember, I'm a discretionary trader as opposed to being automated, so I tend to make an assessment based not just on whether my broad rules are hit, but also based on my judgment and experience. So let me give you some of the broad rules. Now this one, unlike most of my other aspects, doesn't look at technical indicators as such, doesn't look at the MACD, the stochastic, the RSI, which I tend to look at. What I'm looking for, let me tell you the rules first, and then I'll take you through an example. I'm looking for the price to make a higher low. In other words, I'm expecting it to have, let's say, done this, and then fallen off, and then going higher. So that's a higher low. That's one low, and that's a higher low. So I'm expecting for the price to do that. I'm then looking for it to do 3 to 4 day high. The high for the past 3 to 4 days, and that's all fine once it's done that higher low. Then for it to pull back to the previous point, the previous high point. So it'll go up, we're still not in yet, it'll pull back to that type of point, and it's after that that we're looking for an entry for the subsequent rise. Once it's done that, then we're looking to get in. So you can see how we're waiting and waiting and waiting. It's made a higher low, so we've missed this rally, we've missed this rally, we're actually waiting until we get this rally over here. You're still looking for the 2 to 1 risk to reward. So what's your risk? Well, your stop loss is going to be somewhere just beneath this point there. And your reward, you just got to be aware that you don't get knocked out by these points up here as a resistance. But the rewards are usually worth it. There might be times when you can't enter that trade. Remember, this is not always the case. It might be that you just think the risk reward's not worth it. And of course, that's partly based on the stop loss level. So let's actually have a look at something. Add an example with, in this case, Yell Group. You got a low over here, you got a rally, we missed the rally, and that's fine. It then gave a bit of a pullback, and then rose again, made quite a sharp rise, so that's a higher low that we've had at this point here. But we're still not getting in, we had this rally, we missed it. It then pulled back. Now's the entry point. In other words, it rose and it pulled back again to previous levels, as you can see there, and it's once we get an entry point that we enter there, and we're really waiting for maybe a 3 to 4 day high after this point to get in. So it would be somewhere along around here, so some kind of price break just to make sure it isn't going to continue lower. And the stop loss, by the time you've got a 3 to 4 day breakout, you know that you could put a safe stop loss down here. Our only concern with this strategy can be that we don't want to get knocked out by a resistance level at this level when we're up there. So we've got to be careful of some kind of resistance here. But that's it. But other than that, we can shoot for, given that we've got a stop loss down here, we can shoot for fairly good returns as we get the breakout. So notice what I've said. We've missed quite a few rallies. We missed this one, but we didn't kick ourselves. We missed this one, but we didn't kick ourselves. The other thing it shows us is this. If you're a long-term investor, and let's say you got in around here, well, you're probably pretty happy sitting there. But look at how often, by sitting there, that point, you will have the ability to get in again, and it touched several times. And that's my point, that actually markets, they often, you think you've missed a rally, and it often pulls back to it, pulls back again before it actually explodes and moves away. Like I say, you're only going to be right 7 times out of 10. Sometimes stop losses are too tight, you don't want to do the trade. This isn't must happen every time type trade. The rules you saw on the previous page. Let's have a look at another one. So we see one rally, fine, we ignore it. We see this, and we notice when it pulls away again that this is a higher low, because this was a low and this was a low. So we're able to see all of this. We see it pull away and we think, oh, okay, it's pulled away, we missed it again, and it's pulled away. We're still watching, and then we see it pull back to the previous point here. Yeah? And it's when we get that pullback that we're now starting to get interested and say, okay, it's pulled all the way back again. So I didn't get in around here. I didn't get in around here. It's pulled back again. I've got to make sure I put a stop loss beneath that pullback point. and I need to ensure that I've got a breakout, maybe a 3 to 4 day high, before I actually do get in and consider a reward point high enough. What you've got to be careful of, as I said before, is make sure that you don't get this local resistance here. So if you did get in, let's say you got in around here, that you didn't get a hit there and then bounced off, and in this case you didn't, so that was fine. But sometimes that's the other risk with this, that you get blown out there. So look at it again, high or low, so that's the first rally. Second, pull back to that point and then move off. Stop loss down here. Just be aware when setting targets, we might get a bit of a resistance hit there, and it might make the trade end prematurely, in which case should it at worst break even. Fairly tight stop losses, and by the time we've had a 4 day or 3 or 4 day high breakout, you know what the low points down here are anyway. You're not entering too prematurely. You're waiting until you've got a 3 to 4 day high before you put a stop loss down there. Like I say, if it doesn't look good, don't enter it. If it doesn't make sense, don't enter it. If it looks like it might be more risky than it's worth, don't enter it. There is a discretionary element to this. You do want to sometime around here see some good news, see some support before you get in. Now some people might say, well, this is linked a little bit to Elliott waves. You've got 1, 2, 1 and then A, 2 and then B, and then you've got the third wave, which is the major one. Call it what you will, see it how you do. It's entirely up to you. I think it's a variation on it, but it doesn't really matter. And it tends to be, for those who are interested in Elliott waves, it tends to be the third one, which tends to be the biggest anyway, rather than the first or the second. So that's fine by us in any event. It's just that inexperience, it just keeps giving us good returns over and over again. Like I say, sometimes it looks like we've got a setup and we don't enter it and it would have been a good one. Other times you enter it and it just turns out to be foul. And that's the way it is. It's not guaranteed. Nothing is. But it gives you some understanding of price movement and how things work.